What's up everyone, it's Scotty with MoneyVest. So in today's video, we are going to be talking about Enphase energy stock. I'll break down the fundamentals, I'll break down the technicals, we're going to cover everything, why the solar sector has been selling off so aggressively, where's the fair value for Enphase, what I'm planning to do, and also, can it possibly break below $100 and see lows of 90 bucks a share? All of that is going to be discussed in this video. As always, if you enjoy it, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. We'd love to have you on board as a MoneyVest member. The first week of the month is obviously the best time to join, so you can access all the buy and sell alerts, options alerts, trade ideas. Everything is going to be included, as well as the members only private videos, and of course our trade alerts as well. So links are going to be down below. And as always, let's get started. So first things first, let's talk a little bit about why there's been so much weakness in the entire solar sector because of higher interest rates and higher commodity prices and lower discretionary spending. Yes, it is considered as a discretionary spending, at least right now. And we have seen a lot of utility stocks also sell off. I mean, Nextera Energy is a clear example of renewable energy stock that pretty much powers electricity or creates electricity through wind and solar. And that stock has been on a significant sell-off as well, right? So if you come over to NEE, take a look at the last couple of days. Absolutely brutal. If you take a look at XLU, take a last couple of days, just absolute significant sell-off, over 11.7%. If you take a look at TAN, so Invesco Solar ETF, I mean, it's just been on this slow and steady sell-off, down over 32%. Not to mention a lot of companies like Solar Edge. I mean, it is just brutal. Like week after week, this has just been a painful sell-off of 55%. And Enphase obviously is no different. It is part of the renewable energy sector, solar sector, and it's down over 36%. Now trading at a very lucrative support, which I'm going to break down later in the video. Now, Solar Edge stock drops as analyst sees, quote, inevitable price cuts, market share losses. So Solar Edge technology stock dropped Monday after a Barclays analyst predicted continued hard times for the market of solar inverters, high-tech devices that convert the direct current produced by solar panels into the alternating current used in homes. And Barclays analyst Christine downgraded shares of Solar Edge to equal weight from overweight and cut her rating on the stock and the price target down 152 from $274 because she expects, quote, inevitable price reductions, market share losses, and an unfavorable foreign exchange rate as well. So it's a pretty sizable cut that putting pressure on almost all stocks. There are some silver linings here. So Enphase continues to actually expand in other areas, and they are launching new products and launching technology to streamline solar and storage installation in Europe as well. And this right here was the Barclays analyst lowering price target on Enphase Energy as well. And this came out on October 2nd. So adjusting price target on Enphase down to $140 from $155 and reiterating equal weight rating. And this right here is a nice sort of a excerpt for the valuation, right? So if you take a look at the consensus estimates for valuation for Enphase Energy, that is going to be sitting roughly around $5.04 for 2023. And for 2024, that's going to be sitting at $6.47. That puts the company at just 34 times on a GAAP basis and 23.7 times on a non-GAAP basis on an earnings basis here. And the Guru Focus discounted cash flow calculator creates a value of about $126 a share when using about a $5 as a share as the earnings starting point and a 15% 10-year growth rate for the company. So I just want you guys to understand what are they talking about. So the discounted cash flow valuation comes out to around $126 according to Guru Focus, and that is using a $5 EPS in 2023 and using a 15% growth rate for the next 10 years. And using a forward earnings estimates of $647 creates a more reasonable undervalued situation with a price target of about $162. There are 24 Wall Street analysts that cover the stock right now with a company average price target of $186.77, which includes a high target of $262 and a low target of $114. Currently 17 buy ratings and 6 hold ratings and 1 sell rating for the company right now. And finally, 2023, approximately $690 million is the free cash flow estimate for the company, which will be a free cash flow yield of about 4.25%, which obviously is a little bit lower than what you can get from a treasury bond. And as a result, it's not that lucrative right now. So as the price comes down, the market cap decreases, then the free cash flow yield continues to go up. Now, going over to our analysis on the stock. This right here is the entire checklist for Enphase Energy. And again, we're going to be using this spreadsheet more and more on almost all of our stock analysis videos because I want you guys to get familiar with our, method of investing and analyzing stocks. And these are, all the quantitative analysis pieces that we put together: growth, profitability, financial health, and of course, our valuation and efficiency metrics that we look for every single company. Now, I'm not going to spend too much time on this, but in the last 3 years, and the reason I'm going for 2019 is because prior to 2019, the company was not profitable. So we had net losses, we had operating losses. So it just makes for a very chaotic and messy fundamental analysis. So because, since 2019, the company's been very nice, consistently profitable, it is much cleaner for us to analyze these numbers. So revenue, 55% growth here over the last 3 years. Gross profit has grown by another 64%. We got operating income growing by another 62%, and gross profit margins have expanded by over 6% to now 41% here. Operating margins have expanded by 2.5%. EBITDA has been growing at 61.5%, so it's insane how well the growth has been for the company. Net income has grown by 35% for the business. Now, this right here is the only metric that is not checked off, which right here this is the one, and that is going to be the net margins. And net margins have compressed for the company since 2019, and partly because of, I'm assuming, a higher interest rate expense because of higher interest rates, and not to mention inflation, right? Material cost, everything has gone up substantially, and that's kind of eating into some of the margins. And not to mention, the company has also been spending a lot on research and development, technology, and interest expense and taxes as well. So 17.05% is the net margins for the company, which have compressed pretty substantially at 8.76%. So that is definitely something of a yellow flag that we have to be aware of. Now, operating cash flow has grown by 75%. Again, very staggering growth. CapEx has gone up by 46%, but is still a very, very small percentage of the overall revenue, right? So it's actually declined. It's now sitting at just under 2%. As a percentage of revenue. Free cash flow is 186%. So just insane amount of growth here for Enphase's free cash flows. And margins have also expanded to over 18% expansion here, sitting at just over 21.5%. And earnings per share have grown by over 31% for the company, with share dilution only sitting at 3.14%. So a little bit of a yellow flag there, but 3.14% is going to be that number. This right here, definitely a red flag, bit of a concern with net margins kind of declining for the company at the moment. Now, going over to the financial health, the balance sheet is also phenomenal, with only two things to look forward to, and that is that the long-term debt is growing at a faster rate than their cash and investment. So long-term debt is growing at 126% the last 3 years as a compounded annual growth rate, versus cash and investments that are up like almost 86% in that same period. So obviously it's not a sustainable model. The company still has negative net debt, meaning more cash than debt on the balance sheet. Fundamentally, balance sheet is fantastic in terms of the current ratio, quick ratio. All these numbers are phenomenal. Net debt to EBITDA is negative because the company has a negative net debt, because more cash than debt on the balance sheet. And more cash than debt, we got total assets over total liabilities. We got interest coverage ratio of 48.2, solvency ratio of under 20%. So all these numbers are just phenomenal. So Enphase has a phenomenal balance sheet. However, I would still just point out to the fact that the long-term debt is slightly growing at a faster rate compared to the cash and investments. And even though liabilities are growing at a slower rate than assets, it's just that long-term debt is certainly growing at a much faster rate, and total liabilities are growing at a faster rate than total assets as well. But it's just a small amount, like 10% more than current total assets. So those are two things that are a bit of a yellow flag. Nothing to be like super concerned about, but something that we definitely need to be paying attention to for Enphase moving forward. And finally, we come down to efficiency. Excellent margins and excellent efficiency here, coming in at 12.88% return on assets, 48% return on equity, and just under 20% return on invested capital. Now, here's the thing. Efficiency-wise, they have gotten worse, unfortunately. So this right here are two numbers. In other words, revenue per employee and net income per employee. So their employee count has gone from 576 to over 2,800 employees. And the revenue they're making and the profit they're making on a per employee basis has unfortunately gone down. So Enphase, you need to do something better and basically utilize the capital that you have, the employee and the resources that you have better to generate more revenue and more net income so that this number starts to go up, because right now it's trending in the wrong direction. In the last 3 years, it's actually gone down from 1.08 to 0.83. So meaning that they are making less revenue per employee and they're making less profit, almost half the profit per employee right now at 0.14. So that means they're either overhiring or they're not utilizing those employees well. So that's something is certainly a bit of a yellow flag. Company needs to move in the right direction in that sort of particular segment. Now, valuation wise, we are sitting at a little bit of a higher valuation. So if you come over to where we are with the valuation. By the way, this right here was another catalyst. Invesco Solar ETF hits a 3-year low as higher interest rates hurt. So again, TAN is down over 28.5% so far this year, coming down to its 3-year low. Now, when it comes to the valuation on a forward basis, on a non-GAAP basis, we are sitting at a little bit over 23 actually on a non-GAAP basis and 20 on a trailing basis. So these are quite reasonable numbers. And PEG ratio is sitting at 0.81. So on a growth adjusted basis, Enphase definitely does start to look very, very attractive. And enterprise value to EBITDA, we're sitting at a little bit over 18.4. Price to sales sitting at just over 6, and price to cash flow at about 16 to 21 times for the company, which again is quite reasonable, quite low, if you ask me, for the company in terms of its valuation. So we've got a company that again has been doing really well in terms of its overall revenue and its profitability, margins expansion, except for the net income there. Shares outstanding is reasonable. This right here, the balance sheet's also phenomenal. A+ balance sheet, but the only small yellow flags to focus on, of course, long-term debt and total liabilities growing at a faster rate than assets. And this right here is going to be efficiency and valuation. So small yellow flag there with efficiency on employee basis, per employee basis on revenue and profits. But everything else checks all the boxes, most of the boxes, and valuation is also quite reasonable. Now, short interest on Enphase has been increasing. So if you take a look at where short interest was as of September 15th, we're sitting at 11.9 million shares sold short right now, and that is up 11% from last time it was reported, and now it is sitting at over 9%, right? 9% of the float is currently being shorted. That's actually a pretty high number. Like anything close to 10% is considered pretty high. So when it comes to the technical analysis and can Enphase drop below $100, the short answer is yes, it can. Nobody really knows where the prices can go eventually, but I want you guys to understand that it looks really weak, right? I mean, it's been selling off aggressively. It's been making lower highs and lower lows, and to top it all off, the short interest is going higher and higher as it continues to trade down to this support. But the good news is that the lower it gets, the better that deal becomes, yeah, right? Because if you think about a $5 EPS divided by $117, we're looking at a 4.27% earnings yield. Now, let's say that it drops down to $90, right? Now we're looking at a 5.5%. If it drops down to $80, now we're looking at 6.25% earnings yield. So valuation will compress substantially if Enphase drops below $100, which from a technical standpoint, from a short perspective, looking at short sellers and how they've increased their shorts on Enphase, it's possible considering the industry overall, the sector overall is going through some type of a hard time with higher interest rates. But of course, technically, there's a lot of support sitting at the same time. We've got, a triple bottom here. It got validated back in May of 21. We got validated back in February of 22. And once again, here we are testing this level back in October, now here in October in 2023. So even though I consider Enphase at these prices to be somewhat of a good deal, considering the valuation, considering the growth that I just showed you guys, it is going through a bit of a challenging time. And not just Enphase, the entire sector in the industry is. But I also think that this is also a short-term catalyst, right? This is very much short-term. When interest rates start to normalize a little bit going into 2024, if they start cutting rates and there's more subsidies, there's more government support all over the world with solar panels, renewable energy, and micro inverters, and just financially it makes more sense for installing solar panels and adding a micro inverter to have that renewable energy use of electricity instead of using it from the grid. I think more and more people will wake up to the fact that Enphase and of course Solar Edge and Sunrun and a lot of these companies that are offering these services have a lot of value. And of course, long term, I think this is necessary, not just from a discretionary standpoint, from a financial standpoint, but this is also very, very important and essential for climate change and of course global warming and everything that's been going on with fossil fuels and carbon. So let me know in the comment section down below, what do you think about Enphase? Like I said, in my personal opinion, I don't mind total cost averaging a little bit at these prices, but I'm fully aware of the possibility that it could potentially drop below $100, possibly trade down to $90, and that next support really is going to be sitting roughly at around this right here at around 67. Well, that might be a little bit too brutal of a support, but this right here is going to be another support level to watch at around 92 bucks, because we kind of spent a lot of weeks at those prices back in October of 2020 before having a huge breakout. So that would be the next support level in case we see a breakdown below $100 for Enphase Energy. But fundamentally, as I showed you guys in the spreadsheet, it is very strong. Now, finally, let's just quickly go over to our intrinsic value as well. So what I'm going to do is I'm going to basically price in the same 15% growth here for the company. In fact, I'm going to go with 16%, about 20 times P multiple, or a little bit higher because it is considered as a growth stock, 25 times cash flow, 25 times price for free cash flow, 12% discount rate, 10% margin of safety, about a 2% share dilution, and about a 50-50 in terms of that earnings per share and free cash flow, and we get down to a fair value of about $121. And right now, of course, it's trading at 117, which means Enphase can be considered as somewhat undervalued right now. If we put in a little bit more weightage towards earnings per share, it doesn't really make much of a difference. Still at $121, $120 per share, in and around those levels. If you want to be a little bit more conservative, let's go with 20, 20, 20. And now we're looking at a fair value of $88 per share. So I think 25 is quite reasonable because, it's a growth stock. It is going to be a growth stock. I think the earnings per share expectations are also suppressed right now, given what these sector is going through. But 121, 122, I think is quite reasonable for Enphase, given the growth expectations for the future. So let me know in the comment section below, what do you think about this stock? As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. And again, the first week of the month is the best time to join. As always, happy investing. I'll see you all in the next video.